Hey guys, let me ask you this real quick. Would you ever buy a house without checking the foundation or doing any sort of inspection? Exactly, you wouldn't. But I've seen too many business owners buy a business without ever checking what is under the hood. So today, we're going to talk about due diligence and what it is all about. It's not some sort of checklist item that you can skim through last moment. It's a thing that separates a smart buyer from an emotional buyer. I've had buyers tell me all the time different excuses to not pay for due diligence. They've told me things like, oh, I trust the seller. I don't want to spend money on due diligence. I get it. They seem nice. The numbers look decent. You are excited. And you don't want to verify any information because you don't want the deal to go south. And in my experience, that's exactly how emotional buyers think and end up regretting it. So in this video, I'm going to walk you through what due diligence is, why it matters so much, and what you need to look for, and how to protect yourself from making a 6 or 7 figure mistake. And if you haven't met, my name is Anish. I'm an M&A strategist and a business owner. I help everyday business owners buy and sell their company and prepare strategy to help them sell the smart way. Through this channel, I help business owners find financial freedom through business ownership. So what exactly is due diligence? It's basically you as a buyer verifying everything that the seller says. It's like some sort of inspection, but for a business. Now, let's talk about how do sellers come up with the asking price. Most sellers come up with the asking price based on what they want to walk away with. So this is how the process goes. They grab their financials from their accountant, talk to them about add backs and expenses that would not pass to a buyer, and then give that financial statement to a business broker and get together and decide on an asking price. So the basis of the asking price is the financials provided by the seller's accountant. But how do you know those numbers are actually accurate? The question is not that if you trust the seller, but do you trust the accountant the seller used? Do you know what kind of adjustments were made in the first place? And it's not about the seller lying. It's about whether the numbers tell the whole story. And due diligence is how you go deeper. You don't just look into the financials. You look into the financials, the operations, the contracts, people, and risk. It's like doing a full body scan before you commit your money and your future. And here is why this matters. Most sellers aren't hiding things on purpose. They also aren't giving you every single thing that is wrong with the business because they want to sell it. And it's your job to point out all the red flag. Maybe they have been running some personal expenses to the business. Maybe their recurring revenue is actually made up of one-time project, or there is some cost associated with that recurring revenue. Maybe they have a lawsuit that is brewing or money owed to CRA or IRS. Due diligence is your chance to catch those things before they become your problem. I have seen deals fall apart or heavily renegotiated just because what came up during this stage. It completely changes the assumption of the asking price when you go into due diligence. Okay, so let's go into what the due diligence process actually looks like. There are 5 key areas that you need to cover. Firstly, financials. That's financial due diligence. You want to review through 3 to 5 years of tax returns, profit and loss statement, cash flow. You're not looking at just the totals. You're looking at trends and sometimes even daily breakup to just make sure that it all adds up to the monthly and then to the yearly. And you'll be shocked sometimes what you find. Okay, you can validate the add backs. Are they real or are they just creative accounting? Make sure that the working capital itself is sufficient. Owners might say the business only needs X 100,000 of working capital, but is that the real working capital of the business that you're buying? And also, you get to verify the bank statement to the financials. So you're getting a real picture of how the business actually operates. And you'll be surprised how often things don't line up. So the financial part, you need to equip yourself with CPAs, bookkeepers, even an external audit firm to actually have a look into those financial due diligence piece. So it's very crucial, and this is where we have seen a lot of adjustment happens in the asking price. Okay. The second part is legal and corporate due diligence. This is something that can get really tricky and could be a deal breaker in many ways. Who owns the company actually? Are there any liens on the company? Any debts? Any legal issues that is brewing up? You want to go through all the supplier and customer contracts. Also, you want to look at, say, corporate registries, look at small claims court, where you can find if there's any lien or any ongoing litigation that's happening. And also look at customer contracts and supplier contracts. I'll share you a personal experience of mine. Myself and my wife were looking to buy a e-commerce supplement brand. It was developed by a doctor and his wife on a supplements brand for old age people and for pets. They used to sell supplements for anti-aging. So what happened is, when I went through the due diligence process, it was a very good business and it was giving a lot of recurring revenue just because of the license and the trademark that the business had. But then as I went deeper into the contract, I found out that the contract with this particular client would expire if the business is ever sold. And almost 30 to 40% of the revenue was based on this one particular customer. So you may want to look into the customer contract, supply agreement. These are very crucial things. And sometimes even leasehold agreement. Does the lease actually terminate when a new owner takes over? Sometimes in some places, you can only increase your rent a certain percentage. So they come up with a clause that if the business is ever sold, the lease would just restart. This might be a tricky one, but definitely look into anything contract related and have a lawyer look more deeper into this. I would highly recommend. And also, make sure all the licenses, permit, trademark are clean and they're transferable. And now we're going to the third point, that is operations. How does this business actually run on a day-to-day basis? Are there clear systems and SOPs in place? Are there any key employees? And if they're actually planning to stick around after the sale of the company, is the business dependent on a few key employees that runs the whole show? You talk to those employees too at some point, or get to know what that is like. This is a tough one before you buy the business, but sometimes there are toxic employees or certain employees that hold all the cards. So understanding that if the business has clear SOPs and system in place is extremely crucial. And point number 4, customer and market. This is where you look into the customer and market. Who are the top 10 customers? Are they loyal customers? How often do they renew their contracts? Are there any big market threat coming up? Especially with some things like tariffs, things happening all around the world, you want to make sure that you cover this part. You need to understand why they're buying from you. What are their alternatives? Is that contract on a relationship basis? Would they get along with you, or are they looking to continue the relationship with you as a new buyer? Very often they would, but there are certain cases that they wouldn't. Like as I mentioned, is the market shifting? What is coming up in the future? These are definitely things that you want to check about customer and market. And point number 5, technology and systems. We're talking about anything from a software perspective that can actually go wrong, especially when it comes to a tech company. That can be an issue. And even traditional everyday businesses also, this can be an issue. Like sometimes they rely on so much on a software and you need to know a lot about those softwares to even operate in that business. Okay, what software do they use? Is it up to date? Is there a vendor dependency? Do you have to pay X amount of dollars to just use the software? What happens if the software company shuts down? Any cybersecurity risk? Now let's talk about red flags. What are the red flags that you normally see? If the seller doesn't share all the records beforehand, it is a red flag. If the key employees in the business are constantly quitting, that's a red flag. If there is a high employee turnover, that is another red flag. If there are no signed contracts in place, that's another red flag. If 2 or more customers make up most of the revenue, huge red flag. And if you're seeing a lot of ad backs, you need to dig a little bit more deeper into the ad backs and see what is reasonable. I can share a story with you. I have a client who runs a printing business. So they print on t-shirts and shirts. That's their industry. They use a lot of equipments to print these t-shirts and the logos and things like that. So they were looking to buy their competition, and the competition was using heavy ad backs with depreciation. That means they use the depreciation of the asset as an ad back, which is fair in most cases. But in this business, you got to replace that machine every 5 years. So in that particular business, depreciation is a real thing that needs to be calculated. So In the industry, we go with EBITDA, which is earnings before interest, tax, depreciation, and amortization. But in this particular scenario, depreciation was something that we couldn't add back because these machines needs to be replaced every 5 years. So understand what is involved based on your industry. So just don't take the asking price. It's your responsibility to make sure that it is fair for you to pay that price. Most importantly, if your gut says something is wrong, dig more deeper. It's very often that buyers and sellers can get cold feet during a transaction. But if your gut is giving you all the red flags, like I would definitely take a pause, dig a little bit more deeper, and ask yourself if you want to commit to this deal. Due diligence can take anywhere from 30 days to 90 days. And make sure you have the right people on your team. You need a bookkeeper, a CPA, a lawyer, and also most importantly, you need an M&A advisor to advise you through this process. I'll tell you, when it comes to an acquisition, you want to be really careful. You want to understand what you're buying. But depending on how you finance this deal, it could be a leverage deal where you have some sort of financing in place. You want to be very cautious on what you buy because even one deal can cost you more than money. So I would definitely advise you to take more time on due diligence and make sure you're getting exactly what you're paying for. Due diligence is where you protect your investment. And if you want to take it further, there are some insurance companies out there that would insure your deal. Now, if you like videos like this and you want to buy, build business, or sell your company, follow this page. I might have a due diligence checklist in the description. Grab it if it's there. And if you want more videos like this, where I talk about buying companies, selling companies, and building better businesses so you can sell for a higher amount, follow this page. If this helped, I will see you in the next one.